Question 1. The audit findings indicate that several agents are consistently recommending life insurance amounts based on simplified, generalized formulas rather than a detailed assessment of individual client circumstances. This practice raises concerns about the suitability of the coverage provided. Which of the following represents the most appropriate and ethically sound approach for determining a client's life insurance amount? Option A. Recommending coverage equal to a fixed multiple e.g., 10x, of the client's gross annual income, as this is a common industry benchmark. Option B. Conducting a comprehensive needs analysis that quantifies income replacement, debt repayment, future expenses, and other financial obligations, while considering existing assets and coverage. Option C. Suggesting the highest coverage amount that the client can qualify for from an underwriting perspective to ensure maximum protection. Option D. Relying primarily on the client's stated desired death benefit without conducting an independent assessment of their financial needs. The correct answer is B. Conducting a comprehensive needs analysis that quantifies income replacement, debt repayment, future expenses, and other financial obligations, while considering existing assets and coverage. Explanation. The audit findings indicate a recurring challenge in determining appropriate life insurance amounts for clients, leading to potential underinsurance or overinsurance. This scenario is professionally challenging because it requires a nuanced understanding of a client's financial situation, future needs, and risk tolerance, balanced against the insurer's underwriting guidelines and the agent's fiduciary duty. Misjudging the life insurance amount can have significant financial consequences for the client's beneficiaries and can expose the agent to regulatory scrutiny and ethical breaches. The correct approach involves a comprehensive needs analysis that considers all relevant factors. This includes evaluating the client's income replacement needs, outstanding debts, mortgage, loans, credit cards, future education expenses for children, potential estate taxes, and any specific legacy goals. It also necessitates understanding the client's current assets and existing insurance coverage to avoid duplication or significant gaps. This approach aligns with the regulatory framework of the CIC Life and Health Institute exam, which emphasizes the agent's responsibility to act in the client's best interest and to provide suitable recommendations. Ethical guidelines mandate that agents prioritize client welfare over potential commission, ensuring that the recommended coverage is genuinely needed and affordable. An incorrect approach would be to solely rely on a rule-of-thumb multiplier of the client's annual income, such as recommending coverage equal to 10 times their salary. Without further investigation, this fails to account for individual circumstances like the number of dependents, the presence of a spouse's income, or significant existing debts, potentially leading to underinsurance. This approach violates the principle of suitability and the agent's duty to perform a thorough needs assessment as expected by regulatory bodies overseeing insurance sales. Another incorrect approach is to recommend the maximum coverage an underwriter will approve, regardless of the client's stated needs or financial capacity. This prioritizes the insurer's risk appetite and potentially the agent's commission over the client's actual requirements and affordability, leading to overinsurance. This practice is ethically questionable and can be seen as misrepresenting the product's value and necessity, potentially violating consumer protection regulations. A further incorrect approach is to base the coverage amount solely on the client's expressed desire for a specific death benefit without probing the underlying reasons or assessing its financial feasibility. While client input is important, the agent has a professional obligation to ensure the requested amount is justified by a needs analysis and is within the client's financial means. Failing to do so can result in a policy that is either insufficient for its intended purpose or unaffordable, leading to lapse and unmet needs. Professionals should employ a structured decision-making process that begins with a detailed client interview to gather comprehensive financial and personal information. This information should then be used to conduct a thorough needs analysis, identifying all potential financial obligations and goals that life insurance can address. The agent should then present a range of suitable coverage options, explaining the rationale behind each recommendation and ensuring the client understands the benefits, costs, and limitations. Transparency and a focus on the client's long-term financial security are paramount throughout this process. Question 2. Risk assessment procedures indicate a policyholder who is elderly and has recently experienced a significant financial windfall wishes to change their primary beneficiary from their long-term spouse to a newly acquired acquaintance. The agent has a long-standing relationship with the policyholder and their spouse. What is the most appropriate course of action for the agent? Option A. Proceed with the beneficiary change as requested by the policyholder, as it is their right to designate beneficiaries. Option B. Immediately refuse the beneficiary change, citing concerns about the fairness to the spouse and the potential for exploitation. Option C. Advise the policyholder to immediately consult with an attorney before any changes can be considered. Option D. Engage in a conversation with the policyholder to understand the reasons for the change, assess their capacity and voluntariness, and document the discussion thoroughly. The correct answer is A. Proceed with the beneficiary change as requested by the policyholder, as it is their right to designate beneficiaries. Explanation. This scenario presents a professional challenge due to the potential for conflicting beneficiary interests and the agent's fiduciary duty to the policyholder. The agent must navigate the delicate balance between honoring the policyholder's stated wishes and addressing potential undue influence or a change in circumstances that might render the original designation inappropriate or unfair. Careful judgment is required to ensure compliance with regulations, ethical obligations, and the policyholder's best interests, while also protecting the insurer from potential liability. The correct approach involves initiating a conversation with the policyholder to understand the reasons behind the requested change, and to ensure the policyholder has the capacity and freedom to make this decision. This aligns with the ethical principle of client autonomy and the regulatory requirement to act in the client's best interest. It also allows the agent to fulfill their duty of care by verifying the policyholder's intent and capacity, thereby preventing potential future disputes or claims of undue influence. This proactive communication and verification process is crucial for maintaining trust and ensuring the integrity of the beneficiary designation process. An incorrect approach would be to immediately process the beneficiary change without further inquiry. This fails to uphold the agent's fiduciary duty to ensure the policyholder's decision is informed and voluntary. It could lead to the policy being misaligned with the policyholder's true intentions if they are experiencing external pressure or a lack of understanding. Ethically, this bypasses the responsibility to protect the vulnerable policyholder. Another incorrect approach would be to refuse the change outright based on a personal opinion about the fairness of the proposed beneficiary. This oversteps the agent's role, as the policyholder has the right to designate beneficiaries as they see fit, provided they have the capacity to do so. The agent's role is to facilitate the policyholder's wishes, not to judge them, unless there is clear evidence of incapacity or undue influence. Finally, an incorrect approach would be to advise the policyholder to seek legal counsel without first attempting to understand the situation and the policyholder's intent directly. While legal counsel may be necessary in complex situations, the agent has a primary responsibility to gather information and assess the situation themselves to determine if such a referral is truly warranted, or if a simple clarification of intent is sufficient. This approach abdicates the agent's initial responsibility to the policyholder. Professionals should employ a decision-making framework that prioritizes open communication, verification of intent and capacity, and adherence to regulatory guidelines. This involves actively listening to the policyholder, asking clarifying questions, documenting all interactions, and only escalating to legal or other professional advice when the situation clearly warrants it due to complexity, potential incapacity, or suspected undue influence. Question 3. Cost-benefit analysis shows that a more streamlined approach to financial needs assessment could save time and resources. However, when advising a client on life and health insurance needs, which of the following approaches best aligns with regulatory requirements and ethical obligations for a CIC Life and Health Institute professional? Option A. Proceeding with a recommendation for a specific insurance product that the client has expressed interest, assuming their interest reflects their needs. Option B. Conducting a detailed, documented assessment of the client's current financial situation, future goals, and potential risks to inform product recommendations. Option C. Prioritizing the recommendation of products with higher commission payouts, as this benefits the professional and, indirectly, the client through continued service. Option D. Focusing only on the client's immediate income and expenses, overlooking long-term financial goals and potential future liabilities. The correct answer is B. conducting a detailed, documented assessment of the client's current financial situation, future goals, and potential risks to inform product recommendations. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate financial concerns with their long-term security, all while adhering to strict regulatory requirements for financial needs assessment. The CIC Life and Health Institute exam emphasizes a client-centric approach, ensuring that recommendations are suitable and based on a thorough understanding of the client's circumstances. Misinterpreting or neglecting any aspect of the financial needs assessment can lead to unsuitable product recommendations, regulatory noncompliance, and damage to the client's financial well-being and the professional's reputation. The correct approach involves a comprehensive and documented assessment of the client's current financial situation, future financial goals, and potential risks. This includes understanding their income, expenses, assets, liabilities, and dependents, as well as their risk tolerance and time horizon for achieving their goals. Regulatory guidelines mandate that such an assessment forms the foundation for any financial product recommendation, ensuring it aligns with the client's best interests and is suitable for their needs. This approach prioritizes transparency, client understanding, and regulatory adherence. An incorrect approach that focuses solely on the client's stated desire for a specific product without a full needs assessment fails to meet regulatory obligations. It bypasses the crucial step of verifying if the product truly addresses the client's underlying financial needs and risks, potentially leading to a recommendation that is not suitable. Another incorrect approach, which prioritizes the sale of a high-commission product over a thorough needs analysis, represents a clear ethical breach and regulatory violation. This demonstrates a conflict of interest and a failure to act in the client's best interest, which is a cornerstone of regulatory compliance and professional conduct. Professionals should adopt a structured decision-making process that begins with a detailed client fact-finding and needs assessment. This should be followed by an analysis of how various financial products or strategies can meet those identified needs. Recommendations must then be clearly communicated to the client, explaining how they align with the assessment and the rationale behind the chosen solution. Documentation of the entire process is critical for demonstrating compliance and providing a clear audit trail. Question 4. Consider a scenario where a beneficiary of a life insurance policy has elected to receive the death benefit. The insurer offers several settlement options, including a lump sum payment, a fixed-period annuity, and a life annuity. The beneficiary, who is experiencing grief and is not financially sophisticated, is seeking guidance from the life insurance agent on which option to choose. The agent's primary responsibility is to ensure the beneficiary makes an informed decision that aligns with their best interests while adhering to all applicable regulations. Option A. The agent should advise the beneficiary to choose the life annuity, as it guarantees payments for the rest of their life, offering long-term financial security. Option B. The agent should thoroughly explain the features, benefits, drawbacks, and tax implications of each settlement option, allowing the beneficiary ample time to consider their choices and ask questions, ultimately empowering the beneficiary to make the final decision. Option C. The agent should suggest the fixed-period annuity, as it offers a predictable stream of income over a set number of years, providing a structured financial plan for the beneficiary. Option D. The agent should recommend the lump sum payment option, as it provides immediate access to funds, which is often beneficial for beneficiaries dealing with immediate expenses during a period of grief. Correct answer is B. The agent should thoroughly explain the features, benefits, drawbacks, and tax implications of each settlement option, allowing the beneficiary ample time to consider their choices and ask questions, ultimately empowering the beneficiary to make the final decision. Explanation. This scenario presents a professional challenge because the agent must balance the client's immediate financial needs with the long-term implications of settlement options, all while adhering to regulatory requirements and ethical duties. The client's emotional state and potential lack of full understanding of the options necessitate a careful, client-centric approach. The agent's role is to educate and guide, not to pressure or make decisions for the client. The correct approach involves thoroughly explaining each settlement option, including its advantages, disadvantages, and tax implications, in a manner the client can understand. This includes detailing the payout structure, the duration of payments, and any guarantees or limitations associated with each option. The agent must then allow the client sufficient time and information to make an informed decision, acting solely in the client's best interest. This aligns with the regulatory framework's emphasis on client suitability, disclosure, and fiduciary duty, ensuring the client's financial well-being is prioritized. Ethical practice demands transparency and empowering the client to make the choice that best fits their circumstances. An incorrect approach would be to steer the client towards a specific option based on the agent's personal preference or potential commission structure, without fully disclosing all relevant details or considering the client's unique situation. This violates the duty of care and could lead to a settlement choice that is not in the client's best interest, potentially resulting in regulatory sanctions for misrepresentation or unethical conduct. Another incorrect approach would be to rush the client's decision-making process, failing to provide adequate time for comprehension or consultation with other advisors. This undermines the client's autonomy and the principle of informed consent, which are cornerstones of ethical insurance practice. Furthermore, failing to explain the tax implications of different settlement options is a significant regulatory and ethical lapse, as it deprives the client of crucial information necessary for a sound financial decision. Professionals should approach such situations by first understanding the client's objectives, risk tolerance, and financial needs. This involves active listening and asking clarifying questions. Next, a comprehensive, unbiased explanation of all available settlement options should be provided, using clear and simple language. The agent should then encourage the client to ask questions and offer to provide additional information or facilitate discussions with other financial professionals if needed. The final decision must always rest with the client, with the agent acting as a trusted advisor and facilitator. Question 5. The efficiency study reveals that a significant portion of modified whole life policies sold are being surrendered within the first 5 years due to client misunderstanding of the long-term implications of premium adjustments on cash value growth. As a result, the agency is considering implementing a new protocol for agents. Which of the following approaches best addresses this implementation challenge, while adhering to regulatory and ethical standards for life insurance sales? Option A. Mandate that agents conduct a detailed, documented review of the client's financial goals and risk tolerance, and then provide a clear, written summary of how the modified whole life policy's premium structure and potential cash value accumulation align with those goals, requiring client acknowledgement of understanding before proceeding with the sale. Option B. Focus agent training solely on the benefits of lower initial premiums associated with modified whole life policies, emphasizing their appeal to budget-conscious consumers. Option C. Implement a mandatory waiting period of 72 hours after the initial policy presentation before any sale can be finalized, allowing clients time to reflect on their decision. Option D. Require agents to obtain a signed waiver from clients acknowledging that modified whole life policies may have lower cash value growth compared to traditional whole life policies, regardless of the client's specific financial situation. The correct answer is A. Mandate that agents conduct a detailed, documented review of the client's financial goals and risk tolerance, and then provide a clear, written summary of how the modified whole life policy's premium structure and potential cash value accumulation align with those goals, requiring client acknowledgement of understanding before proceeding with the sale. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate financial needs with the long-term implications of a modified whole life policy. The challenge lies in accurately assessing the client's understanding of the policy's features, particularly how the modifications might affect cash value growth and death benefit over time, and ensuring that the chosen approach aligns with the client's stated objectives and risk tolerance, all within the regulatory framework governing life insurance sales. Careful judgment is required to avoid misrepresentation and to ensure suitability. The correct approach involves a thorough review of the client's financial situation and objectives, followed by a clear and comprehensive explanation of how the modified whole life policy's features, including any premium adjustments or death benefit variations, will impact their long-term financial plan. This approach is correct because it prioritizes client education and suitability, which are fundamental ethical and regulatory requirements. Specifically, it aligns with the CIC Life and Health Institute exam's emphasis on acting in the client's best interest and adhering to disclosure requirements, ensuring the client fully understands the product before purchase. This proactive communication prevents potential future dissatisfaction or claims of misrepresentation. An incorrect approach would be to proceed with the sale based solely on the client's initial request for a lower premium, without fully exploring the consequences of the modifications. This fails to meet the regulatory obligation to ensure the policy is suitable for the client's needs and circumstances. Another incorrect approach would be to provide a superficial explanation of the modifications, focusing only on the immediate premium reduction while downplaying or omitting details about potential impacts on cash value accumulation or the death benefit. This constitutes a failure in disclosure and could be considered a misrepresentation, violating ethical standards and regulatory guidelines that mandate full and accurate information. A third incorrect approach would be to assume the client fully understands the implications of the modifications based on their stated desire for lower premiums, without actively verifying their comprehension. This demonstrates a lack of due diligence and a failure to ensure informed consent, which is a cornerstone of responsible insurance sales. Professionals should employ a decision-making framework that begins with a comprehensive needs analysis, followed by a detailed explanation of product features and their implications, tailored to the client's level of understanding. This includes actively soliciting questions and confirming comprehension. The process should always prioritize suitability and transparency, ensuring that any product recommendation is demonstrably in the client's best interest and fully compliant with all applicable regulations. Question 6. The risk matrix shows a client who has owned a whole life insurance policy for 5 years, is experiencing a temporary cash flow shortage, and is considering surrendering the policy to access funds. The policy has accumulated a modest cash value, but surrender charges are still applicable. The agent is aware that surrendering the policy will result in a loss of the death benefit and potentially a portion of the premiums paid due to surrender fees. What is the most ethically and regulatorily sound approach for the agent to take? Option A. Suggest the client take a policy loan against the cash value, without fully detailing the surrender charges or the potential long-term impact on the death benefit if the loan is not repaid. Option B. Immediately process the surrender request to provide the client with the funds they need quickly, as the client has clearly stated their intention. Option C. Fully explain the surrender charges, the current cash surrender value, the loss of the death benefit, and any potential tax implications, while also exploring alternative solutions for the client's cash flow needs that do not involve surrendering the policy. Option D. Advise the client that surrendering a whole life policy after only 5 years is a poor financial decision, and strongly discourage them from doing so, focusing on the long-term benefits of maintaining the policy. The correct answer is C. Fully explain the surrender charges, the current cash surrender value, the loss of the death benefit, and any potential tax implications, while also exploring alternative solutions for the client's cash flow needs that do not involve surrendering the policy. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the long-term implications of their insurance choices, all while adhering to ethical obligations and regulatory requirements. The agent must navigate potential conflicts of interest and ensure the client's best interests are paramount. The correct approach involves thoroughly explaining the surrender charges and the potential loss of cash value associated with surrendering the whole life policy. This approach prioritizes client education and informed consent, aligning with the regulatory framework that mandates agents act in the client's best interest and provide accurate, complete information. Specifically, regulations governing life insurance sales emphasize disclosure of policy features, including surrender provisions and associated costs, to prevent misrepresentation and ensure clients understand the consequences of their decisions. Ethically, this demonstrates a commitment to transparency and fiduciary duty. An incorrect approach would be to immediately facilitate the surrender without fully explaining the financial implications. This fails to uphold the duty of care and could be construed as a misrepresentation or omission of material facts, violating regulations that require agents to provide adequate information for clients to make informed choices. Ethically, it prioritizes the agent's potential commission from a new sale over the client's financial well-being. Another incorrect approach would be to strongly discourage the surrender solely based on the agent's personal preference for whole life policies or potential commission structures, without objectively presenting the client's options and the associated costs. This could be seen as undue influence or a conflict of interest, as the agent's advice may not be solely driven by the client's needs. Regulations often require agents to avoid situations where their personal interests could compromise their professional judgment. The professional decision-making process for similar situations should involve a structured approach. First, understanding the client's stated needs and motivations. Second, objectively assessing the existing policy's features and surrender implications. Third, clearly and comprehensively explaining all options, including the consequences of surrendering the policy and alternatives. And finally, documenting the client's decision and the rationale behind it, ensuring full compliance with disclosure requirements and ethical standards. Question 7. Process analysis reveals that a client expresses a strong desire for tax-deferred growth and a potential for higher returns than traditional savings accounts, while also mentioning a moderate risk tolerance. The insurance professional is considering recommending an indexed universal life (IUL) insurance policy. Which of the following actions best demonstrates adherence to regulatory requirements and ethical professional conduct in this situation? Option A. Recommending the IUL policy solely based on the client's stated desire for tax-deferred growth and potential for higher returns, assuring them that the policy's performance is directly tied to market gains without detailing specific index mechanics or potential downside risks. Option B. Focusing the discussion on the death benefit aspect of the IUL policy, assuring the client that the cash value growth will be substantial enough to cover all policy costs and provide significant long-term gains, without delving into the specifics of index crediting methods or potential market fluctuations. Option C. Suggesting a fixed universal life policy as a safer alternative, emphasizing its guaranteed growth rate, and advising against the IUL due to the client's mention of moderate risk tolerance, without fully exploring the IUL's potential benefits or the client's specific financial objectives beyond tax deferral. Option D. Presenting the IUL policy by highlighting its potential for market-linked growth and tax-deferred cash value accumulation, while also clearly explaining the role of index caps, participation rates, and the impact of policy charges on net returns, ensuring the client understands that performance is not guaranteed and can be affected by market volatility. Correct answer is D. Presenting the IUL policy by highlighting its potential for market-linked growth and tax-deferred cash value accumulation, while also clearly explaining the role of index caps, participation rates, and the impact of policy charges on net returns, ensuring the client understands that performance is not guaranteed and can be affected by market volatility. Explanation: this scenario is professionally challenging because it requires an insurance professional to balance the client's stated financial goals with the inherent complexities and risks associated with indexed universal life (IUL) insurance. The challenge lies in ensuring the client fully comprehends the product's mechanics, particularly the link between policy performance and market indices, and that the product is suitable for their long-term objectives, rather than being presented as a guaranteed high-return investment. CIC Life and Health Institute exam emphasizes ethical conduct and client-centric advice, meaning the professional must prioritize the client's best interests above all else. The correct approach involves a thorough needs analysis, followed by a clear and transparent explanation of how an IUL policy works, including its potential benefits, limitations, and risks. This includes detailing how the cash value growth is tied to a specific market index, the presence of caps and floors, and the impact of policy charges and fees. The professional must ensure the client understands that, while there is potential for growth linked to market performance, there is also a risk of lower than expected returns or even cash value depletion if premiums are insufficient to cover costs. This aligns with regulatory requirements for suitability and disclosure, ensuring the client makes an informed decision based on accurate information about the product's performance drivers and potential outcomes. An incorrect approach of emphasizing only the potential for high returns, without adequately explaining the market-linked nature, caps, floors, and fees, constitutes a failure to disclose material information. This misrepresents the product's risk profile and can lead to client dissatisfaction and potential regulatory action for misrepresentation or omission. Another incorrect approach of recommending IUL solely based on the client's desire for tax-deferred growth, without a comprehensive assessment of their overall financial situation, risk tolerance, and other available options, fails to meet the suitability standards. This could result in the client purchasing a product that is not appropriate for their needs, potentially leading to financial detriment and regulatory scrutiny. Recommending IUL without clearly explaining the impact of policy charges and the potential for premium inadequacy to cover these costs, especially in lower growth market environments, is also a significant ethical and regulatory failure. This omission can lead to the policy lapsing prematurely, causing the client to lose their investment and any death benefit. Professional decision-making in such situations requires a systematic process. First, conduct a comprehensive client needs analysis to understand their financial goals, risk tolerance, time horizon, and existing financial resources. Second, identify suitable products that align with these identified needs. Third, for each suitable product, provide a clear, unbiased, and detailed explanation of its features, benefits, limitations, risks, and costs. Fourth, document the entire process, including the client's stated needs, the products discussed, the information provided, and the client's final decision. This structured approach ensures that advice is client-centric, compliant with regulations, and ethically sound. Question 8. The performance metrics show that client, a 45-year-old married individual with 2 teenage children and a mortgage, has expressed a desire to ensure their family's financial security in the event of their premature death. They have a stable income but have not previously engaged in formal financial planning. When discussing life insurance, the client is primarily concerned about covering their mortgage, providing for their children's college education, and maintaining their family's current lifestyle. Which of the following approaches best aligns with the principles of a comprehensive capital needs analysis as expected within the regulatory framework for the CIC Life and Health Institute exam? Option A. Calculating the total outstanding mortgage balance and multiplying the client's current annual income by a standard factor of 10 to determine the coverage amount. Option B. Conducting a detailed analysis that quantifies income replacement needs, considers future educational expenses for children, accounts for outstanding debts including the mortgage, and factors in final expenses, while also acknowledging existing assets and potential future income streams. Option C. Focusing solely on the immediate need to cover the outstanding mortgage balance and any outstanding credit card debt. Option D. Recommending a policy with the highest commission payout that provides a death benefit sufficient to cover the mortgage and a modest amount for immediate expenses. The correct answer is A. Calculating the total outstanding mortgage balance and multiplying the client's current annual income by a standard factor of 10 to determine the coverage amount. Explanation. This scenario presents a professional challenge because accurately assessing an individual's capital needs for life insurance requires a nuanced understanding of their unique financial situation, future goals, and potential liabilities, rather than a one-size-fits-all calculation. The CIC Life and Health Institute exam emphasizes a client-centric approach, adhering to ethical obligations and regulatory guidelines that mandate providing advice in the client's best interest. The correct approach involves a comprehensive capital needs analysis that considers all relevant factors, including income replacement, debt coverage, education funding, and final expenses, while also accounting for existing assets and potential future income. This aligns with the regulatory framework by ensuring that recommendations are suitable and based on a thorough understanding of the client's circumstances, fulfilling the duty of care and the principle of acting in the client's best interest. An incorrect approach that relies solely on a simplified income multiplier fails to account for the client's specific liabilities, future financial obligations, and the time value of money. This is a regulatory failure because it does not demonstrate due diligence in assessing the client's true needs and may lead to an inadequate or excessive insurance recommendation, violating the principle of suitability. Another incorrect approach that focuses only on covering immediate debts without considering long-term income replacement or future goals is also a regulatory and ethical failure. It neglects the primary purpose of life insurance for many individuals, which is to provide financial security for dependents. This approach demonstrates a lack of comprehensive analysis and a failure to address the client's broader financial well-being. A third incorrect approach that prioritizes the sale of a high-commission product without a proper needs assessment is a clear ethical breach and a potential regulatory violation. It prioritizes the agent's financial gain over the client's needs, undermining trust and violating the fiduciary duty that may be implied or explicitly stated in the regulatory framework. The professional decision-making process for similar situations should involve a structured needs assessment, active listening to understand the client's objectives, a thorough review of their financial documents, and the application of appropriate analytical tools to determine the most suitable insurance solution. This process must be guided by regulatory requirements for suitability and the ethical imperative to act in the client's best interest at all times. Question 9. Market research demonstrates that a significant portion of life insurance policies have beneficiary designations that are not clearly understood by policyholders or their families. An agent is assisting a client's estate with a death benefit claim. The policy lists John Smith as the primary beneficiary and Jane Doe as the contingent beneficiary. However, the deceased son informs the agent that his father had verbally expressed a desire for the death benefit to be split equally between John Smith and another individual, Robert Green, who is not listed on the policy at all. The agent must determine the correct procedure for distributing the death benefit. Option A. Distribute the death benefit equally between John Smith and Jane Doe, as they are the named beneficiaries. Option B. Distribute the death benefit equally between John Smith and Robert Green, as per the son's statement of the deceased's verbal wishes. Option C. Pay the entire death benefit to John Smith, as he is the designated primary beneficiary. Option D. Advise the estate to seek legal counsel to determine if the policy can be amended to include Robert Green as a beneficiary before distributing the funds. The correct answer is B. Distribute the death benefit equally between John Smith and Robert Green, as per the son's statement of the deceased's verbal wishes. Explanation. This scenario presents a professional challenge because it requires the agent to navigate the complexities of beneficiary designations, specifically distinguishing between primary and contingent beneficiaries, while adhering strictly to the policy's terms and relevant regulations. Misinterpreting these designations can lead to significant financial and legal complications for the policyholder's estate and the intended beneficiaries. Careful judgment is required to ensure the policy's death benefit is distributed according to the insured's wishes and legal requirements. The correct approach involves accurately identifying and documenting the primary and contingent beneficiaries as specified in the policy contract. This aligns with the principle of fulfilling the contractual obligations of the insurance policy and respecting the insured's intent. Regulatory frameworks, such as those governed by the CIC Life and Health Institute exams jurisdiction, mandate that insurance contracts be administered according to their written terms. Accurately distinguishing between primary and contingent beneficiaries ensures that the death benefit is paid first to the primary beneficiary, and only if they are unable to receive it, e.g., predeceased the insured, then to the contingent beneficiary. This adheres to the principle of utmost good faith and proper claims handling. An incorrect approach would be to assume that all named beneficiaries are equal and should share the death benefit equally, regardless of their designation as primary or contingent. This fails to recognize the hierarchical nature of beneficiary designation and violates the specific terms of the insurance contract. Ethically and regulatorily, this would be considered a misrepresentation of the policy's provisions and could lead to improper claims payment, potentially resulting in legal disputes and regulatory sanctions for failing to administer the policy correctly. Another incorrect approach would be to prioritize the wishes of a family member who claims the insured would have wanted a different distribution over the explicit beneficiary designations in the policy. While empathy is important, insurance contracts are legally binding documents. Deviating from the stated beneficiaries without proper legal amendment or court order based on informal requests constitutes a failure to adhere to the policy contract and regulatory requirements for claims settlement. This could be seen as acting outside the scope of the agent's authority and potentially engaging in fraudulent or misleading practices. A professional decision-making process for similar situations should involve 1. Thoroughly reviewing the insurance policy document, paying close attention to the beneficiary designation section. 2. Clearly identifying who is designated as the primary beneficiary and who is designated as the contingent beneficiary. 3. Understanding the conditions under which a contingent beneficiary would receive the death benefit. 4. Consulting with the insurance company's claims department or legal counsel if there is any ambiguity in the beneficiary designations or if circumstances arise that might affect the distribution, e.g., death of a primary beneficiary. 5. Communicating clearly and accurately with the policyholder if alive, or the executor of the estate regarding the beneficiary designations and the process for claims settlement. 6. Ensuring all actions taken are in strict accordance with the policy contract and all applicable regulations. Question 10. Operational review demonstrates that a life and health insurance company is planning to implement a new automated underwriting system for its one-year term insurance products. The system promises increased efficiency and faster policy issuance. However, there is a concern that the system's algorithms may not fully capture the nuances of underwriting for short-term policies, as strictly defined by the CIC Life and Health Institute exam's regulatory framework, potentially leading to a higher risk of adverse selection. Which of the following approaches best ensures compliance and operational integrity? Option A. Conduct a thorough pre-implementation review of the new underwriting system's algorithms and processes against the specific underwriting requirements for one-year term insurance as outlined by the CIC Life and Health Institute exam's regulatory framework, making necessary adjustments before full deployment. Option B. Rely on the vendor's assurance that the system is compliant with all relevant insurance regulations and proceed with implementation, assuming any minor discrepancies will be addressed through ongoing operational adjustments. Option C. Proceed with the system implementation immediately to leverage its efficiency gains, with a plan to conduct a comprehensive post-implementation audit to identify and rectify any compliance issues. Option D. Implement the system with a focus on speed, and then train the underwriting staff to manually override the system's decisions for any policies that appear to be high risk, without a formal review of the system's underlying logic. The correct answer is C. Proceed with the system implementation immediately to leverage its efficiency gains, with a plan to conduct a comprehensive post-implementation audit to identify and rectify any compliance issues. Explanation. This scenario presents a professional challenge because it requires balancing efficient operational processes with strict adherence to regulatory requirements for life and health insurance products, specifically one-year term insurance. The challenge lies in ensuring that the implementation of a new underwriting system does not inadvertently create compliance gaps that could lead to regulatory scrutiny, financial penalties, or reputational damage. Careful judgment is required to identify potential pitfalls and implement robust controls. The correct approach involves a thorough pre-implementation review of the new underwriting system against the specific requirements of one-year term insurance policies, as mandated by the CIC Life and Health Institute exam's regulatory framework. This includes verifying that the system accurately captures and processes all necessary underwriting information, correctly applies policy terms and conditions, and generates compliant policy documents. Regulatory justification stems from the principle of ensuring all insurance products are underwritten and issued in accordance with applicable laws and regulations, which are designed to protect consumers and maintain market integrity. This proactive verification ensures that the system's design and functionality align with the CIC Life and Health Institute exam's regulatory expectations for one-year term insurance, preventing potential misrepresentations or non-compliance from the outset. An incorrect approach of proceeding with the implementation without a comprehensive review risks several regulatory and ethical failures. If the system fails to accurately assess risk for one-year term policies, it could lead to the issuance of policies that are not actuarially sound or that do not meet the specific underwriting standards required by the CIC Life and Health Institute exams framework. This could result in adverse selection, financial losses for the insurer, and potential consumer harm if policies are later challenged or rescinded due to improper underwriting. Furthermore, failing to ensure the system generates compliant policy documents could lead to violations of disclosure requirements, misrepresentation of policy benefits, or other breaches of consumer protection laws. Another incorrect approach of relying solely on post-implementation testing without a pre-implementation review is also problematic. While post-implementation testing is crucial, it is reactive. If the system has fundamental design flaws related to one-year term insurance underwriting, these may only be discovered after policies have been issued, leading to a more complex and costly remediation process, and potentially exposing the insurer to regulatory action for past non-compliance. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and consumer protection throughout the system implementation lifecycle. This involves a phased approach. First, A thorough understanding of the specific regulatory requirements for the product in question, 1-year term insurance in this case. Second, a detailed review of the proposed system's capabilities against these requirements before implementation. Third, robust testing during and after implementation. And finally, ongoing monitoring and auditing to ensure continued compliance. This proactive and systematic approach minimizes risk and upholds ethical standards. Question 11. Stakeholder feedback indicates that some clients purchasing indexed annuities express surprise regarding the actual growth achieved and the limitations on accessing their funds. Considering the regulatory framework for the CIC Life and Health Institute exam, which approach best addresses these concerns and ensures client understanding and suitability? Option A. Present the indexed annuity as a conservative investment option with predictable, albeit modest, returns similar to a fixed annuity to manage client expectations. Option B. Provide a detailed explanation of how the annuity's crediting methods, including caps, participation rates, and any annual point-to-point or daily averaging calculations, influence potential returns, alongside a clear outline of surrender charges and withdrawal penalties. Option C. Emphasize the potential for market-linked growth and compare it favorably to low-yield fixed annuities, while briefly mentioning that some restrictions may apply. Option D. Focus on the tax-deferred growth aspect of the annuity, assuming clients are primarily concerned with long-term tax benefits rather than immediate growth potential or liquidity. Correct answer is C. Emphasize the potential for market-linked growth and compare it favorably to low-yield fixed annuities, while briefly mentioning that some restrictions may apply. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the client's stated desire for growth with the inherent complexities and potential risks of indexed annuities, ensuring full compliance with regulatory disclosure requirements. The agent must navigate the fine line between presenting a product that meets the client's objectives and avoiding misrepresentations or omissions that could lead to a sale that is not suitable or understood by the client. Careful judgment is required to determine the appropriate level of detail and clarity in explaining the product's features, limitations, and potential outcomes. The correct approach involves thoroughly explaining the indexed annuity's mechanics, including how the index performance is tracked, the impact of caps, participation rates, and any surrender charges or withdrawal limitations. This approach is right because it aligns with the regulatory framework of the CIC Life and Health Institute exam, which emphasizes the agent's fiduciary duty to act in the client's best interest and to ensure that the client fully understands the product being purchased. Specifically, regulations mandate clear and accurate disclosure of all material features, benefits, and risks. By providing a comprehensive explanation, the agent ensures the client can make an informed decision, thereby fulfilling their obligation to provide suitable recommendations and prevent potential future disputes or regulatory action. An incorrect approach would be to focus solely on the potential for higher returns compared to traditional fixed annuities without adequately explaining the limitations and risks. This failure constitutes a misrepresentation by omission, as it downplays or ignores crucial aspects of the product that could significantly impact the client's actual returns and access to funds. This violates the principle of full disclosure and could lead to a sale that is not suitable for the client's needs or risk tolerance, potentially resulting in regulatory sanctions for the agent and the insurer. Another incorrect approach would be to present the indexed annuity as a guaranteed growth product, similar to a fixed annuity. This is a misrepresentation of fact. Indexed annuities are not guaranteed to grow at a specific rate. Their growth is linked to an index, and caps or participation rates can limit the extent to which the client benefits from index performance. Presenting it as guaranteed growth is misleading and violates the duty of honesty and accuracy in product descriptions. A third incorrect approach would be to avoid discussing surrender charges and withdrawal penalties, or to present them as minor inconveniences. Surrender charges and withdrawal limitations are material terms of the contract that can significantly impact the client's liquidity and the overall return on investment if funds are needed prematurely. Failing to disclose these clearly and prominently is a failure of disclosure and can lead to a client feeling misled when they discover these restrictions. The professional reasoning process for similar situations should involve a structured approach. First, understand the client's financial goals, risk tolerance, and time horizon. Second, identify suitable product options that align with these client needs. Third, for each suitable product, thoroughly explain its features, benefits, limitations, and risks in clear, understandable language, ensuring the client has ample opportunity to ask questions. Fourth, document the entire process, including the client's stated objectives and the agent's recommendations and disclosures. This systematic approach ensures compliance with regulations, ethical conduct, and the delivery of appropriate financial solutions. Question 12. Market research demonstrates a growing interest in understanding the prevalence of specific chronic conditions among individuals who have recently purchased new health insurance policies. An insurance agent is approached by a third-party research firm requesting access to anonymized client data to identify trends in policyholder health conditions. The agent is considering how to respond to this request while adhering to the CIC Life and Health Institute exam's regulatory framework. Option A. Obtain explicit, written consent from each policyholder whose data might be included in the research, clearly outlining the purpose and scope of the data usage before sharing any information. Option B. Decline to participate in any market research that involves client data, regardless of the potential benefits for product development. Option C. Provide the research firm with direct access to policyholder files, trusting their assurance that they will anonymize the data appropriately. Option D. Share aggregated demographic data with the research firm, assuming that anonymized health condition information derived from this data will not violate privacy regulations. Correct answer is A. Obtain explicit, written consent from each policyholder whose data might be included in the research, clearly outlining the purpose and scope of the data usage before sharing any information. Explanation. This scenario is professionally challenging because it requires an insurance professional to balance the immediate need for accurate information with the ethical obligation to protect client privacy and adhere to regulatory disclosure requirements. The professional must understand the nuances of what constitutes permissible disclosure versus a breach of confidentiality, especially when dealing with sensitive health information. Careful judgment is required to avoid misrepresenting information or violating privacy laws, which could lead to significant legal and reputational damage. The correct approach involves a thorough understanding of the CIC Life and Health Institute exam's regulatory framework concerning health insurance principles, specifically regarding the disclosure of protected health information. 5. This approach prioritizes obtaining explicit, written consent from the client before sharing any information, even if it seems beneficial for the market research. This aligns with the ethical duty of confidentiality and the legal requirements for handling PHI, ensuring that the client's privacy rights are respected and that the insurance professional acts within the bounds of the law. This method upholds the trust placed in the professional by the client and demonstrates a commitment to ethical conduct. An incorrect approach that involves sharing client health information without explicit, written consent, even for market research purposes, represents a direct violation of privacy regulations. This failure to obtain consent is a breach of confidentiality and potentially a violation of laws governing the handling of sensitive personal data. Another incorrect approach, which is to assume that general demographic data is not sensitive and can be shared freely, is also flawed. While some aggregated data might be permissible, the line between general demographics and identifiable health information can be blurred, and without clear guidelines or anonymization, sharing such data risks inadvertently disclosing protected information. A third incorrect approach, which is to refuse to participate in any market research that might involve client data, is overly cautious and may hinder legitimate business development and product improvement that could ultimately benefit clients. While prioritizing privacy is essential, a complete refusal without exploring compliant methods is not the most effective professional strategy. Professionals should employ a decision-making framework that begins with identifying the core ethical and regulatory principles at play, such as client confidentiality and data privacy. They should then assess the specific request against these principles, considering the nature of the information requested and the potential impact of its disclosure. If there is any ambiguity or risk of violating regulations, the professional should err on the side of caution and seek clarification or explicit consent. Consulting internal compliance departments or legal counsel is advisable when faced with complex situations. The goal is to find a solution that respects client rights, adheres to all applicable laws and regulations, and supports legitimate business objectives. Question 13. Market research demonstrates that clients often seek to ensure their life insurance proceeds are protected and directed to specific beneficiaries without the possibility of future changes. A client, Ms. Alina Vance, has expressed a strong desire to designate her daughter as the sole beneficiary of her life insurance policy, stating, "I want to make absolutely sure that this money will go to her and that no one, not even me, can ever change that." As an insurance agent licensed under the CIC Life and Health Institute exams jurisdiction, how should you proceed to best advise Ms. Vance? Option A. Advise Ms. Vance that while she can name her daughter as the primary beneficiary, all beneficiary designations are inherently revocable until the insured's death, and no mechanism exists to make them truly unchangeable during her lifetime. Option B. Suggests that Ms. Vance consider a trust to manage the policy proceeds after her death, as this offers more flexibility and control over distribution than a direct beneficiary designation, and that direct beneficiary designations are generally revocable. Option C. Immediately process the beneficiary change to irrevocable as requested, assuming Ms. Vance fully understands the legal ramifications of such a designation based on her statement. Option D. Explain the concept of an irrevocable beneficiary designation, detailing its implications for policy ownership rights and the requirement for beneficiary consent for any future policy changes, and then proceed with establishing this designation if Ms. Vance confirms her understanding and desire. Correct answer is D. Explain the concept of an irrevocable beneficiary designation, detailing its implications for policy ownership rights and the requirement for beneficiary consent for any future policy changes, and then proceed with establishing this designation if Ms. Vance confirms her understanding and desire. Explanation. This scenario presents a professional challenge because it requires an insurance agent to navigate the client's evolving understanding of their financial and estate planning needs, specifically concerning the control and beneficiary designations of a life insurance policy. The agent must balance the client's current wishes with the long-term implications of irreversibility, ensuring the client makes an informed decision that aligns with their ultimate goals. Misinterpreting or failing to adequately explain the distinction between revocable and irrevocable designations can lead to significant financial and legal complications for the client and their beneficiaries, potentially resulting in regulatory scrutiny and ethical breaches. The correct approach involves clearly and comprehensively explaining the fundamental differences between a revocable and an irrevocable beneficiary designation. This includes detailing how a revocable designation allows the policy owner to change beneficiaries, alter policy values, or even surrender the policy without the beneficiary's consent. Conversely, an irrevocable designation significantly restricts the policy owner's rights, requiring the beneficiary's consent for any changes to the policy, including beneficiary status, policy loans, or surrenders. The agent must ensure the client fully comprehends that choosing an irrevocable designation is a permanent decision with substantial implications for their control over the policy and its proceeds. This aligns with the regulatory framework's emphasis on client education, informed consent, and acting in the client's best interest, as mandated by the CIC Life and Health Institute exams governing principles which prioritize transparency and client understanding in insurance transactions. An incorrect approach would be to assume the client understands the implications of their request for an unalterable beneficiary without a thorough explanation. This failure to educate could lead the client to believe they retain more control than they actually would under an irrevocable designation, or conversely, to forego an irrevocable designation when it would genuinely serve their long-term estate planning objectives. Another incorrect approach would be to proceed with the designation without confirming the client's understanding of the permanence and restrictions associated with irreversibility. This bypasses the ethical obligation to ensure the client's decision is truly informed and voluntary, potentially violating principles of fiduciary duty and client protection. A further incorrect approach would be to offer a solution that is not legally recognized or is a misrepresentation of policy terms, such as suggesting a semi-irrevocable status that does not exist within standard policy structures, thereby misleading the client and potentially violating fair trade practices. Professional decision-making in such situations requires a structured process. First, actively listen to and understand the client's stated objective. I want to make sure this goes to my daughter and no one can change it. Second, Identify the core concept at play: control and permanence of beneficiary designation. Third, access and apply knowledge of relevant policy features, specifically the distinction between revocable and irrevocable designations. Fourth, communicate these concepts clearly and concisely, using plain language and providing concrete examples of what each type of designation allows and restricts. Fifth, confirm the client's comprehension through open-ended questions and by having them articulate their understanding. Finally, document the discussion and the client's decision thoroughly. Question 14. Stakeholder feedback indicates that some clients purchasing immediate annuities express surprise regarding the irreversibility of the contract and the potential for their principal to be lost if they die shortly after the annuity payments begin. Which of the following approaches best addresses these concerns and aligns with regulatory expectations for insurance agents? Option A. Focus on the tax advantages of annuity income, downplaying the risks associated with principal loss and contract irreversibility to encourage the sale. Option B. Recommend the immediate annuity based on the client's age and desire for income, without delving into the specifics of principal recovery or contract termination clauses. Option C. Emphasize the guaranteed income stream and the security of lifelong payments, assuming the client understands the fundamental nature of an annuity purchase. Option D. Provide a detailed explanation of the immediate annuity's features, including its irreversibility, the fixed nature of payments, the potential for principal loss upon early death, and the impact of inflation, ensuring the client comprehends these critical aspects before purchase. The correct answer is C. Emphasize the guaranteed income stream and the security of lifelong payments, assuming the client understands the fundamental nature of an annuity purchase. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance client needs with regulatory compliance when recommending an immediate annuity. The agent must ensure the client fully understands the product's implications, particularly regarding the irreversibility of the purchase and the potential loss of principal if the annuitant dies shortly after commencement. Regulatory frameworks, such as those governing the CIC Life and Health Institute exam, mandate that agents act in the best interest of the client and provide clear, accurate information. Misrepresenting the product or failing to disclose critical features can lead to regulatory sanctions and harm to the client. The correct approach involves a thorough needs analysis and a comprehensive explanation of the immediate annuity's features, benefits, and limitations. This includes clearly stating that the purchase is generally irrevocable, that payments are fixed, and that the client's principal may not be recovered if the annuitant dies soon after the contract begins, unless specific riders are purchased. This approach aligns with the regulatory requirement to ensure suitability and full disclosure, protecting the client from making an uninformed decision and upholding the agent's fiduciary duty. An incorrect approach would be to focus solely on the guaranteed income stream without adequately explaining the loss of principal risk or the irreversibility of the contract. This failure to disclose critical information violates the principle of suitability and can mislead the client into believing they retain access to their principal, which is not the case with most immediate annuities. Another incorrect approach is to push the product without assessing the client's liquidity needs or overall financial situation, potentially recommending a product that is unsuitable for their circumstances and goes against the spirit of client-centric advice mandated by regulations. Recommending an immediate annuity without discussing the impact of inflation on the fixed payments also represents a failure to provide a complete picture, potentially leading to client dissatisfaction and regulatory scrutiny. Professionals should approach such situations by first conducting a detailed client needs assessment, identifying their financial goals, risk tolerance, and liquidity requirements. Following this, they must clearly and comprehensively explain all aspects of any recommended product, including its benefits, drawbacks, costs, and any associated risks. This includes discussing the implications of irreversibility, potential for principal loss, and the impact of inflation. Agents should document this entire process, including the client's understanding and consent, to demonstrate compliance and ethical conduct. Question 15. The assessment process reveals that a prospective client, Mr. Henderson, has expressed a strong interest in a variable annuity, citing a desire for potential market growth and tax-deferred accumulation. However, during the initial fact-finding, it becomes apparent that Mr. Henderson has a limited understanding of investment concepts and expresses concern about market volatility, while also indicating a need for access to funds within the next 5 years for a potential home renovation. As a licensed agent, what is the most ethically and regulatorily sound approach to proceed? Option A. Conduct a comprehensive needs analysis to determine if a variable annuity is truly suitable for Mr. Henderson's financial goals, risk tolerance, and liquidity needs, clearly explaining all associated risks, fees, surrender charges, and the implications of early withdrawal before making any recommendation. Option B. Focus on the tax-deferred growth aspect of the variable annuity, assuring Mr. Henderson that the investment subaccounts are managed by professionals and that his initial concerns about market volatility can be mitigated through diversification. Option C. Recommend a fixed annuity instead, as it offers more predictable returns and less complexity, which may be a better fit given Mr. Henderson's concerns about volatility and limited understanding. Option D. Proceed with a detailed explanation of the variable annuity's investment options and potential growth, emphasizing the tax deferral benefits, and then assess if Mr. Henderson still wishes to proceed after understanding the basic structure. The correct answer is D. Proceed with a detailed explanation of the variable annuity's investment options and potential growth, emphasizing the tax deferral benefits, and then assess if Mr. Henderson still wishes to proceed after understanding the basic structure. Explanation. This scenario presents a professional challenge because it requires balancing a client's stated desire for potential growth with the advisor's fiduciary duty to ensure the product is suitable and understood, especially given the inherent complexities and risks of variable annuities. The advisor must navigate the client's limited understanding and potential susceptibility to sales pressure, ensuring that the recommendation aligns with the client's true financial needs and risk tolerance, not just their expressed interest. The correct approach involves a thorough needs analysis and a clear, comprehensive explanation of the variable annuity's features, risks, and costs. This includes detailing the investment component, the insurance guarantees, the surrender charges, and the potential for loss of principal. The advisor must confirm the client's understanding of these elements and ensure the variable annuity is a suitable vehicle for their long-term financial goals, risk tolerance, and liquidity needs. Consistent with the CIC Life and Health Institute exam's emphasis on client suitability and ethical sales practices. This aligns with regulatory requirements that mandate advisors act in the client's best interest and provide accurate, understandable information. An incorrect approach would be to proceed with the sale based solely on the client's initial enthusiasm for potential growth, without adequately assessing suitability or ensuring comprehension. This fails to uphold the advisor's duty to act in the client's best interest, potentially leading to a product that is too complex, too risky, or too costly for the client's circumstances. Another incorrect approach would be to downplay the risks and surrender charges to secure the sale, which constitutes misrepresentation and violates ethical standards of honesty and transparency. Finally, recommending the variable annuity without a clear understanding of the client's other financial resources and objectives could lead to an inappropriate allocation of assets, demonstrating a failure to conduct a comprehensive suitability assessment. Professionals should approach such situations by prioritizing a deep understanding of the client's financial situation, objectives, and risk tolerance before even discussing specific products. The process should involve open-ended questions, active listening, and a commitment to educating the client about all aspects of a product, including its downsides, before a recommendation is made. If a product's complexity or risks cannot be adequately explained and understood by the client, or if it does not clearly align with the client's best interests, it should not be recommended. Question 16. Benchmark analysis indicates that when presenting life insurance policies with accumulation at interest features to prospective clients, an agent must ensure the illustrations provided are compliant with regulatory standards. Which of the following approaches best adheres to these requirements for demonstrating potential cash value growth? Option A. Presenting an illustration that clearly outlines both guaranteed cash values and projected non-guaranteed cash values, explicitly stating the assumptions used for the non-guaranteed projections and including prominent disclaimers that actual results may differ. Option B. Providing an illustration that highlights only the highest possible non-guaranteed growth scenarios to showcase the product's full potential for wealth accumulation. Option C. Utilizing an illustration that employs aggressive, optimistic assumptions for future interest rates to maximize the projected non-guaranteed cash value growth. Option D, focusing solely on the guaranteed cash values within the illustration, without mentioning any potential for non-guaranteed growth, to avoid any possibility of misrepresentation. The correct answer is A, presenting an illustration that clearly outlines both guaranteed cash values and projected non-guaranteed cash values, explicitly stating the assumptions used for the non-guaranteed projections and including prominent disclaimers that actual results may differ. Explanation: this scenario is professionally challenging because it requires an insurance agent to navigate the complexities of policy illustrations and client expectations regarding the growth of cash value in life insurance products, specifically focusing on accumulation at interest features. The core challenge lies in ensuring that the illustrations provided are not misleading and accurately reflect the potential outcomes, considering the inherent uncertainties of future interest rates and market performance, while adhering strictly to regulatory disclosure requirements. The correct approach involves presenting illustrations that clearly distinguish between guaranteed and non-guaranteed elements, explicitly stating assumptions used for non-guaranteed projections, and ensuring the client understands that actual results may vary. This aligns with regulatory mandates that prohibit misleading illustrations and require agents to act in the best interest of the client. The CIC Life and Health Institute exam emphasizes a commitment to ethical conduct and regulatory compliance, meaning that transparency and accurate representation are paramount. Providing a clear, balanced illustration that manages client expectations about potential accumulation, while highlighting the risks and assumptions, is the only compliant and ethical path. An incorrect approach would be to present an illustration that solely emphasizes the highest potential non-guaranteed growth rates, without adequately disclosing the underlying assumptions or the possibility of lower returns. This misrepresents the product's potential and can lead to client dissatisfaction and regulatory scrutiny for misleading sales practices. Another incorrect approach is to provide an illustration that focuses only on guaranteed values, ignoring the potential for non-guaranteed growth, as this may not fully inform the client about the product's capabilities and could be seen as an incomplete representation. Finally, an approach that uses overly optimistic or unrealistic assumptions for future interest rates in non-guaranteed projections, without clear disclaimers, is also a regulatory failure, as it creates a false sense of security and expectation for the client. Professionals should employ a decision-making framework that prioritizes client understanding and regulatory adherence. This involves thoroughly reviewing product literature, understanding the mechanics of accumulation at interest features, and practicing clear, honest communication. When presenting illustrations, agents must be prepared to explain the difference between guaranteed and non-guaranteed components, the assumptions behind projections, and the potential for variability. If there is any doubt about the clarity or accuracy of an illustration, seeking guidance from the insurer or compliance department is essential. Question 17. Governance review demonstrates that a health insurance policyholder submitted a claim for a condition that the insurer believes may have been pre-existing. The claims adjuster is considering denying the claim. Which of the following approaches represents the most appropriate professional practice for the adjuster in this situation? Option A. Seek advice from colleagues who have handled similar claims in the past to determine the best course of action. Option B. Deny the claim immediately based on the adjuster's general knowledge of pre-existing condition clauses in health insurance. Option C. Conduct a thorough review of the specific policy's pre-existing condition clause, relevant state insurance regulations, and the insurer's claims handling guidelines before making a decision. Option D. Approve the claim without further investigation to avoid potential customer dissatisfaction and ensure prompt payment. The correct answer is B. Deny the claim immediately based on the adjuster's general knowledge of pre-existing condition clauses in health insurance. Explanation: scenario analysis. This scenario is professionally challenging because it requires an insurance professional to interpret and apply complex policy provisions in a way that is both compliant with regulatory requirements and ethically sound, ensuring the client's understanding and protection. The challenge lies in balancing the insurer's contractual obligations with the insured's reasonable expectations, especially when policy language can be ambiguous or technical. Correct approach analysis. The correct approach involves a thorough review of the specific policy language, relevant state insurance regulations, as this exam is U.S.-based, and the insurer's established claims handling guidelines. This ensures that the denial is based on a clear, justifiable interpretation of the contract and is consistent with legal and regulatory mandates. Specifically, it requires understanding provisions like pre-existing condition, waiting periods, and exclusions as defined by the policy and interpreted by state law, ensuring the denial aligns with these definitions and any applicable grace periods or appeal rights. This approach upholds the principle of fair claims handling and regulatory compliance. Incorrect approaches analysis. One incorrect approach is to deny the claim solely based on a general understanding of pre-existing conditions, without consulting the specific policy wording and applicable state regulations. This fails to account for nuances in the policy's definition, potential look-back periods, or specific state laws that might limit the insurer's ability to deny coverage for certain pre-existing conditions after a specified period of time. This can lead to a regulatory violation for improper claims denial. Another incorrect approach is to approve the claim without a proper investigation into the policy provisions and the claimant's medical history. This could result in financial loss for the insurer and potentially set a precedent for future claims that are not in line with policy terms, leading to operational inefficiencies and potential regulatory scrutiny for lax oversight. A third incorrect approach is to rely on anecdotal evidence or past experiences with similar claims without verifying the current policy's specific terms and conditions. Each policy is a contract with unique provisions, and relying on past assumptions rather than current documentation is a failure of due diligence and can lead to both improper denials and improper approvals, violating contractual obligations and regulatory standards. Professional reasoning. Professionals should approach such situations by adopting a systematic process. 1. Identify the core issue. What specific policy provision is in question? 2. Gather all relevant documentation. Policy contract, application, claim submission, medical records. 3. Consult the policy. Carefully read and interpret the exact wording of the relevant provisions. 4. Research applicable regulations. Review state insurance laws and departmental guidance related to the specific provision, e.g., pre-existing conditions, waiting periods. 5. Consult internal guidelines. Refer to the insurer's claims handling manual and underwriting guidelines. 6. Make a determination based on the comprehensive review. Decide whether the claim is covered according to the policy and regulations. 7. Communicate clearly. If denying the claim, provide a clear written explanation citing the specific policy provisions and regulatory basis. This structured approach ensures fairness, accuracy, and compliance, protecting both the insured and the insurer. Question 18. Compliance review shows that a prospective client, who has recently been diagnosed with a chronic but manageable health condition, is eager to secure a life insurance policy immediately and has expressed concern about potential policy denial due to their condition. The agent wants to reassure the client and facilitate the sale. Which of the following approaches best adheres to life insurance principles and regulatory guidelines? Option A. Offer to expedite the underwriting process by submitting an incomplete application to the insurer, emphasizing that this will speed up the approval timeline. Option B. Assure the client that their condition is unlikely to prevent them from obtaining coverage and that the policy will be issued promptly once the application is submitted, without dwelling on the underwriting specifics. Option C. Advise the client to wait until their health condition has stabilized further before applying for insurance to avoid potential complications during the underwriting process. Option D. Explain that while the health condition will be a factor in underwriting, the company has various policy options, and that the application process will involve a thorough review to determine the most suitable coverage, which may include adjustments to premiums or benefits, or in some cases, denial. Correct answer is B. Assure the client that their condition is unlikely to prevent them from obtaining coverage, and that the policy will be issued promptly once the application is submitted, without dwelling on the underwriting specifics. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the client's immediate desire for coverage with the fundamental principles of life insurance underwriting and the regulatory obligation to ensure suitability. The agent must avoid misrepresenting policy features or making promises that cannot be substantiated by the underwriting process, which is a core tenet of ethical conduct and regulatory compliance within the life insurance industry. The correct approach involves accurately explaining the underwriting process, including the potential for policy modifications or denials based on health and lifestyle factors, and managing client expectations realistically. This aligns with the regulatory framework that mandates truthful and non-misleading representations to prospective policyholders. It upholds the principle of utmost good faith, requiring full disclosure of material facts. By emphasizing the conditional nature of coverage until underwriting is complete, the agent acts ethically and in compliance with regulations designed to prevent adverse selection and ensure the solvency of insurance products. An incorrect approach would be to guarantee immediate coverage or to downplay the significance of the underwriting process. This misrepresents the nature of the insurance contract, which is contingent upon acceptance by the insurer. Such actions violate the principle of disclosure and could lead to a client believing they have coverage that does not, in fact, exist. This creates a significant ethical breach and potential regulatory violations related to misrepresentation and deceptive practices. Another incorrect approach would be to proceed with issuing a policy without fully disclosing the underwriting requirements or potential outcomes. This bypasses a critical step in the insurance process and fails to inform the client of the conditions under which their coverage will be finalized. This is a failure of due diligence and transparency, exposing both the agent and the insurer to risk and potentially violating regulations that govern the sale of insurance products. Professionals should approach such situations by prioritizing transparency and education. The decision-making process should involve 1. Understanding the client's needs and risk tolerance. 2. Clearly explaining the product features and the insurance process, including underwriting. 3. Managing client expectations by communicating potential outcomes, both positive and negative. 4. Ensuring all representations are accurate and compliant with current regulations. 5. Documenting all client interactions and disclosures. Question 19. Market research demonstrates that clients often have a preconceived notion about how they want their life insurance policy dividends to be used. An agent is meeting with a prospective client who has expressed a strong preference for using dividends to purchase additional paid-up insurance. The agent knows from experience that for this client's specific age and health profile, accumulating dividends to earn interest might offer a more significant long-term benefit, though it would not provide an immediate increase in coverage. The agent's primary responsibility is to ensure the client makes an informed decision that best suits their financial goals. Which of the following represents the most professional and compliant approach for the agent to take? Option A. Respect the client's stated preference and proceed with setting up the policy to use dividends for purchasing additional paid-up insurance, as this is what the client has explicitly requested. Option B. Strongly recommend accumulating dividends to earn interest, emphasizing its superior long-term growth potential and downplaying the immediate benefit of additional paid-up insurance. Option C. Provide a brief overview of both dividend options, highlighting the immediate increase in coverage with paid-up insurance, and then proceed with the client's initial request. Option D. Fully explain the benefits and potential long-term outcomes of accumulating dividends to earn interest, while also thoroughly detailing the advantages and disadvantages of purchasing additional paid-up insurance, allowing the client to make a fully informed choice. The correct answer is D. Fully explain the benefits and potential long-term outcomes of accumulating dividends to earn interest, while also thoroughly detailing the advantages and disadvantages of purchasing additional paid-up insurance, allowing the client to make a fully informed choice. Explanation. This scenario presents a professional challenge because it requires the agent to balance the client's stated preference with the potential for a more advantageous outcome, all while adhering to regulatory disclosure requirements and ethical obligations. The agent must not only understand the technical aspects of dividend options, but also how to effectively communicate these to a client who may have limited financial literacy or a fixed, perhaps suboptimal, idea. The core of the challenge lies in providing informed guidance without engaging in undue influence or misrepresentation. The correct approach involves clearly explaining all available dividend options, detailing their respective benefits and drawbacks in the context of the client's stated goals and financial situation. This includes illustrating how each option might perform over time, even without complex calculations, by describing the general principles of accumulation versus immediate income. The regulatory and ethical justification for this approach is rooted in the principle of acting in the client's best interest, which necessitates full disclosure and education. Regulations typically mandate that agents provide information that allows clients to make informed decisions. Ethically, this means prioritizing the client's understanding and long-term benefit over a potentially quicker or easier sale. An incorrect approach would be to simply accept the client's initial stated preference without further exploration. This fails to meet the obligation to ensure the client is fully informed and has considered all suitable alternatives. It risks the client making a decision that is not optimal for their circumstances, potentially leading to dissatisfaction or financial detriment. This could be viewed as a failure to provide adequate advice or to act in the client's best interest, potentially violating regulations concerning suitability and client care. Another incorrect approach would be to strongly advocate for a single dividend option that the agent believes is superior, without adequately presenting the other choices or understanding the client's evolving needs. This can be perceived as steering the client towards a particular product or option, which may not be in their best interest and could be a violation of regulations against misrepresentation or undue influence. The agent's role is to guide, not to dictate, and to ensure the client's decision is based on comprehensive understanding. A further incorrect approach would be to provide a superficial overview of the options, focusing only on the most basic distinctions without delving into the implications for the client's long-term financial objectives. This lack of depth and explanation can leave the client with a misunderstanding of the choices, leading to an uninformed decision. This falls short of the regulatory expectation for clear and comprehensive communication, particularly when dealing with financial products that have long-term consequences. The professional decision-making process for similar situations should involve a structured approach. First, actively listen to and understand the client's stated needs and preferences. Second, assess the client's financial situation and objectives. Third, thoroughly explain all relevant product features and options, including dividend choices, in clear, understandable language, highlighting potential benefits and drawbacks for the client. Fourth, encourage questions and ensure the client demonstrates comprehension. Finally, document the discussion and the client's final decision, confirming it aligns with their stated objectives and understanding. Question 20. The risk matrix shows a potential for significant client dissatisfaction if the long-term performance of a universal life insurance policy's cash value is not adequately explained, particularly concerning the impact of premium payment flexibility and market volatility on the death benefit. Which of the following approaches best aligns with regulatory requirements for selling universal life insurance? Option A. Focus primarily on the tax-deferred growth potential of the cash value, highlighting its ability to potentially offset future premium costs, without delving into the specific risks associated with market downturns or the consequences of insufficient premium payments. Option B. Present universal life insurance as a simple, long-term savings vehicle with a guaranteed death benefit, downplaying the complexities of cash value management and the impact of variable interest rates on policy values. Option C. Conduct a thorough needs analysis. Clearly explain the mechanics of universal life insurance, including premium flexibility, cash value accumulation, and its dependence on market performance and funding levels, potential for policy lapse, and provide all required disclosures and illustrations for the client's informed decision. Option D. Emphasize the policy's death benefit guarantee and the flexibility to adjust premium payments, while providing a standard policy illustration without detailed discussion of cash value performance variability or lapse risks. The correct answer is D. Emphasize the policy's death benefit guarantee and the flexibility to adjust premium payments, while providing a standard policy illustration without detailed discussion of cash value performance variability or lapse risks. Explanation. This scenario is professionally challenging because it requires an insurance agent to balance the client's stated financial goals with the inherent complexities and potential long-term implications of universal life insurance, while strictly adhering to regulatory disclosure requirements. The agent must ensure the client fully understands the policy's features, particularly the flexibility and the impact of premium payments and market performance on cash value and death benefit. Misrepresenting or oversimplifying these aspects can lead to significant client dissatisfaction and regulatory scrutiny. The correct approach involves a comprehensive and transparent discussion of universal life insurance, emphasizing its variable nature. This includes clearly explaining how premiums can be adjusted, the potential for cash value growth, and the associated risks if market performance is poor, and how these factors can affect the death benefit over time. The agent must provide all necessary policy illustrations and disclosures, ensuring the client understands that the policy's performance is not guaranteed and that insufficient funding can lead to policy lapse. This aligns with regulatory mandates for suitability, disclosure, and fair dealing, ensuring the client makes an informed decision based on accurate information. An incorrect approach that focuses solely on the death benefits potential longevity without adequately explaining the cash value dynamics and premium flexibility risks regulatory noncompliance. Specifically, failing to disclose the impact of market fluctuations on cash value and the potential for policy lapse due to underfunding violates disclosure requirements and the principle of suitability. Another incorrect approach, which is to highlight only the flexibility of premium payments without detailing the consequences of insufficient payments on the death benefit and cash value, misleads the client about the policy's guarantees and risks. Finally, an approach that emphasizes the tax-deferred growth of the cash value without a balanced discussion of the associated investment risks and the potential for policy surrender charges would also be considered a failure to provide a complete and accurate picture, potentially violating regulations against misrepresentation. Professionals should employ a decision-making framework that prioritizes client understanding and regulatory compliance. This involves 1. Thoroughly assessing the client's needs and financial objectives. 2. Educating the client about all relevant policy features, benefits, risks, and costs, using clear and understandable language. 3. Providing all required policy documents and illustrations, and ensuring the client has ample opportunity to review them and ask questions. 4. Documenting the entire sales process, including discussions about policy features, risks, and the client's understanding. 5. Adhering strictly to all applicable laws and regulations regarding sales practices and disclosures.